Who y'all got? V. V.
All right, we are about, let's see, 2.5 minutes away from getting finally back into it. So we're gonna wait a little bit to try and get as many people in here as we can. And it does look, so we are using a different laptop this time because the main one is gonna have to be sent in. But I think the processing power on this one might be a little bit lower than what we're used to. So if we're having any issues with the stream, please let me know in the chat. And if you can hear me right now also, it would be helpful if you let me know to make sure that I set everything up correctly. And appreciate all the follows that we're getting in. All right, perfect, perfect, perfect. Was worried when I first started this thing up, it gave me a encoding overload error. So I was worried that it was completely about to fall apart, but good to know that we are up and running and good to go in a minute and a half here. All right, and that takes us down to the end of our timer. Let me get that out of the way and get flipped back over so I can see the chat. All right, and we are ready to go. We already got one question in the Twitch chat. Also, first of all, welcome if this is your first time joining, and everyone who's back in on this with us. Appreciate you guys popping back in. It has been far too long since I have sat late at night in the corner of my bedroom and talked to myself while assuming that you guys were listening in. But typically, we'll talk about what we have open right here. You could see, let me flip over to the 2021 tracker tab in our spreadsheet. We'll talk through a little bit of what we've got open. I know a lot of us play similar stocks. Thank you, more for the follow. I know you've been lurking a little bit, so it means a lot to have the official follow from you. But basically what we're doing in here, going through kind of what I've got right now, talking about my mindset with some of these trades, how we plan to manage these. And then after that, that shouldn't take too long. It's pretty much free game. It's back and forth between if they're either stocks that you guys want to look at or things about the strategy that you guys don't understand. Like I know we had a little bit of a discussion in the Discord server about, spreads and how they work. So if that's something we want to work out here, and I could show you guys kind of the mechanisms behind different parts of the strategies that we run, that's also a conversation we could have, but we can just kind of cross that bridge when we get into it. We always appreciate it when we've got all these people active in the chat and tuning in, because, the more you guys give me, the more I can give you, and I think it benefits both of us a lot. Sierra, appreciate you checking in as well. I'm glad we finally gave myself the kick in the ass I needed to go pick up this new laptop. Hopefully the original laptop makes it back to me soon at some point, but for now, this is what we've got, so let's kick it off. So at the top of the list, what we've got here is the UWMC shares, and for those of you that have been following along with us, you are probably in a similar situation with all these. I mean, these things have just kept bleeding out for a little bit of time. We could pull the chart up, so we could take a look at it while we talk about it, but zooming out, I think 20-day probably will illustrate what I'm going for here. But we had this bump up to $10 where we thought, okay, these were all going to get called away from us. We were going to hit some profit. Things were finally going to get resolved with this trade. And then honestly, just a brutal, I think this might be roughly the day that they announced they weren't going to be listed in the Russell Index. And that's one of those things where they're not going to be listed for this quarter, but it's going to be revisited during the summer. So that's kind of one of those things I have in the back of my mind where, okay, that's a potential upcoming catalyst where the first time around, we had that news bring us up near the $10 mark. In a month or two, once we hit June, once we hit July, and that speculation starts to come again, if they are put on the list for potential additions to the Russell Index, I imagine that kind of speculation will drive a similar price increase. So it's one of those things we've talked about. We have videos on our YouTube channel about how solid of a stock we feel UWMC is. So we're sticking to this one. We're going to continue lowering our basis week after week. The one thing that does kind of suck, let me flip back here to the trade tab for UWMC, is looking ahead to May, the premium isn't the best. Now, what's great is that the volume is still there. We still see a lot of call volume, so there still is a lot of bullish sentiment surrounding this stock. But I think we might be able to get 20-25 cents for these 9-strike calls, and that's just going to be something we have to deal with. We have to be patient. I know a lot of the people in here, maybe we have some people in here who were in on the Nokia trade. And I know we had a user in our Discord server, I don't know if he's on this stream right now, but Tank, he stuck with that one and finally got his cost basis below the price of Nokia today. So that's an awesome example of patience, and really just a bigger example of the patience we need overall with this strategy for when stocks like this turn against us. We can still chip away, 20 cents a month. Even looking out to June, I mean, if you wanted to get super impatient and sell something 2 months away, you could get a little bit bigger chunk of premium, but I still think that I'm partial to the month-to-month premium selling. And looking at how our trade on that one stacks up, we've still got this tab named GHIV, and that's a good point from Sierra's UWMC, and we could pull it up in our watch list here. UWMC, they have earnings on May 5th. You've got it. So this next set of calls that we're going to be selling at the end of this week, hopefully, they're going to include an earnings period. So that's hopefully something that's good news for us, because we know UWMC is a solid company. If they keep putting out good quarter after good quarter after good quarter, maybe potentially declare a special dividend of some sort, that could be a super bullish development for us. But that's why, they pay a quarterly dividend. We're going to keep our head down on this, keep selling calls. Looking at our trade individually, I mean, this is one that's been coming together for a little bit of time. We've been playing this since back before the merger when it was GHIV. But our break-even price on it right now is $7.25. assuming that these 7.5 strike puts expire worthless on Friday. And then from there, we'll just be able to, probably what I'm going to do is sell the 9 strike calls here for 20 to 25 cents a premium and get our break-even price down near $7 flat. Now, the one good thing about my break-even price is it factors in, at 7.25 here, just for an example. Let me zoom in on this as well. Hopefully that worked. Yeah, so at 7.25, this would be $378. Or excuse me, at 7.25, this wouldn't expire worthless, so that's factored into the break-even price. Whereas if this expires worthless, so let me hard code a 0 in there, our break-even price is going to be even lower. We could put 7 in there. Oops. 7.2 maybe. 7.3. 7.25. What this makes me think is that my formula is not capturing everything, and we would be correct. So good to be, thank you for being patient as I look through the errors in my spreadsheet here. But our break-even price would then be something around 680 maybe. This is kind of how I found my break-even price. There's not really an official way. I just kind of plug until I get close. Yeah, so roughly 687 I think is going to be the break-even price if these both expire worthless. Now, if those didn't expire worthless and it dropped below 750 and went all the way down to 725, the value on the 7.5 put would bring that back up to break even. So that's why 725 is currently the break even price. But assuming that UWMC expires above 750 on Friday and we could sell more calls for the next period, our break even price will be 687, which we could then decrease by another 20 cents. And that might have been a little bit of word salad. So hopefully some of you guys followed along with what I was saying right there. But using the Google Finance function right here to get the actual price back up here, this is what we got right now. We're going to play it on, I guess Friday is going to be the big day for us, the monthly expiry. So we're going to have a lot of positions that we need to adjust, and this is just another one. This one shouldn't be too tough. Quick recap of everything I just said is that we're going to be selling the 9 strike calls. And the other thing I wanted to mention is that these are still open despite the fact... that's a side. These are still open, excuse me. We're going to roll these down to 9 strike as well to collect a little bit more extrinsic value, and we could show that here by going into option theoreticals and Greeks. Where did it go? Extrinsic right here. So what we could see, the difference between the 9 strike and the 10 strike is about 7 cents of extrinsic value. Well, obviously, that's not a ton. And honestly, another thing that we could think about doing here is just rolling down to 7.5 to get as much extrinsic value as possible. I do like having a little bit of upside on these puts by going with the 9 or a 10 strike, just because of what we just talked about with all the potential bullish catalysts. And this really isn't one I'm willing to give up yet. So going back to the tracker and the other things that we've got working, VGAC we gave up on. We took the L on that. That one we chased a little bit up at the $14 range, and I could pull the chart up to kind of run back through the timeline of what happened with this one. We're gonna have to back up a little bit further than this. We tried to chase right around here because there was a ton of premium on the options. They had just spiked up to 18, so we thought there was some pretty good upside, and then unfortunately it just kind of leveled back out at that 10 net asset value price. And you might be thinking, okay, they're pre-merger, it's right at net asset value, what's the downside right now? And in the short term, there really isn't a ton of downside. So, I mean, if you wanted to just buy the stock straight up, not a terrible idea. They did announce they're merging with 23andMe, one of those, DNA genealogy companies. I forgot. I think it might be 23andMe. But until they have that merger, they can't really drop too far below 10. So you might be thinking, okay, SPAC at net asset value, that's probably a good entry. But the issue that we have right here is if we look ahead to May premiums, there's really nothing going on here. And these 10 strike calls, we don't like to buy options in here, but this doesn't seem like too bad of a deal to get 20 cents a premium, or to buy something for 20 cents where there's not too much downside in the near future, and you potentially could pop back up to 11 and 5x your investment. Never will officially advocate for buying calls, but this one isn't that bad of a setup if this is something you're interested in. But long story short, the lack of premium here, which is good for option buyers, as we just illustrated, the lack of premium here from our perspective, being an option seller, this is something, it's just not worth it, and our money was better spent elsewhere. So we took the loss on that one. PSTH, this one might be better if I pop over to the trade breakout tab as well. Our break even's 25.88, which we started playing this thing at 31.49 back in mid-February. So we're coming up on 2 months on this one, but I mean, we're just going to keep chipping away at the break-even price week after week. 25.88 this week after those 26 calls that we sold. Those look like they're going to finish out of the money. So we could just sell 26 calls again on April 23rd, and those are going for another, 40, 50 cents. So we'll be able to knock that break-even price down to low 25s, which is, exactly what you want to do. Be patient week after week after week, and then hopefully this thing, at some point, Bill Ackman comes up with some sort of deal announcement for us, and all the people who've been loyal to PSTH in our Discord so far over the past few months or so, the Zebra Gang, could finally make a little bit of profit on that investment. But, it's not too exciting to explain what we're doing with this one, but you just got to trust the process with stuff like this. It gets super annoying when you enter, at 31.49 and the stock drops 21.66% on you. That's obviously never fun. We are very partial to when we jump into something, it goes up and we are able to hit max profit right off the bat. But that's not the reality of trading. I think the bright side about this, if this can illustrate anything, is the fact that this thing's dropped almost 22% and we're still floating right around our break-even price. And that's the value of the strategy when we're able to find setups like this, and maybe not even so much the setups, but being able to find, such good premium on a week-to-week basis. That's the benefit of that. You just keep chopping that break-even price down. And eventually, this thing can't go down forever. So if we get a green week or two out of this, we'll hopefully be able to get out of that trade with a little bit of profit. And then further moving down the list of what we've got set up for this week, LOTZ, that's the next one. That one is hovering right around the strike price. Yeah, so it's dead on the strike price as of close, 750, as you can see right here. What was happening with that one is we got a little bit impatient with the 10 strike puts that we had. And maybe not so much impatient, but the fact of the matter was that if we looked at extrinsic value, let me pull it up really quickly again. There's zero extrinsic value on these 10 strike puts. And that largely is because, we're 2 days from expiry on these, but a week or two ago when we actually made this play, there was still zero extrinsic value. And the advantage that we have as option sellers is decay of this extrinsic value. So it gives us a little bit of a cushion just in case we're wrong, and that's what we love about our strategy here. But we had the 10 strike puts, they had zero extrinsic value, so at that point, it was essentially a glorified stock position that we were holding. So we closed out of those, rolled down to 7.5 strike puts, which now still have 15 cents of extrinsic value. We'll hopefully get out of those sometime sooner. Hopefully by Friday they'll expire worthless. And then our plan there is to roll into these 7.5 strike puts. And just to illustrate, we've got someone in the chat saying LOTZ has been killing them. And you and me both over this month or so, it's been brutal the way this thing's just almost entirely collapsed. But looking at what we've got right here, so far in this trade, we've lost about $1,500, assuming that this expires worthless. Now, that is coupled with a 30% roughly decrease in the stock price. So the fact that we're still, relatively floating around break even, not too bad. But our plan for this, have these expire at 7.5. Looking back at here, what has the most extrinsic value? It's these right here, since these are pretty much at the money. Every cent of that premium is going to be extrinsic value. We should be able to get 70 cents for those. And if we roll those over, pull this formula down, and add up the new number in here, there you have it. We'll finally be at a gain, albeit it took 3 months to get it, and it's only a 3.2% return on capital. But, not the worst thing in the world when something's dropping this hard against you. And again, that's the benefit of when we seek out these plays with this inflated premium. The fact that we could just play this thing down over and over and over again. So that's the plan with LOTZ. Let those 7.5 strike puts for this Friday expire. Get into some for May, and then let those ride for another month. And the good part about these is this individual leg here, probably isn't. Let me flip back there really quickly. this individual leg here isn't going to really kill us too much because we know if we're getting 70 cents of premium on a 7.5 strike put, we've got a 680 break-even price. And if we go to the LOTZ chart, really hasn't been too close except for one, really big red candle that we had here back at the beginning of March. But I think that's a relatively safe play. If this is something that, you've been reading about, you haven't gotten in on it, this is a really solid entry offering that much premium for that strike on a stock like this with this kind of entry point. And since this is a new laptop, I don't have RSI or implied volatility plotted on here. So let me do that right now. We're going to go to add study, all studies, and going to the R's, it's going to be at the top right here, RSI. And this would indicate, it's probably beginning to level up. I had a comment asking if we haven't been assigned, why keep trading it? And that's a great question. I think it always is important to evaluate your trades, especially the losers. Like, look, do I want to stay in this? I've been losing money. And the answer for us is yes. On a fundamental basis, I think they've got a solid business. And to give more credence to that idea, we aren't the only ones who think that way. If you look into the news right here, the analysts from one of the investment banks that cover it, and I can guarantee you they do far more in-depth research than we could do right here on our live stream. They've got a price target of $22. So I think there's a lot of good upside on this stock. And that's why I'm going to want to keep playing it. And we go back over here, instead of volume, let's switch over to return on risk, since that's the metric we like to look at for returns. 10% return on something like this for just over a month, or just at a month rather, is a pretty solid return, a pretty steady return, and something that I think is relatively safe. So objectively, it is important to look, okay, look, we're losing in this position. Do we want to keep rolling our puts? Do we want to stay in this position? And based off everything we've seen from this one and know about this stock, I think this one's a yes when you take into consideration the amount of premium here, the strike, the entry point, and the outlook, different price targets that banks have. Like, if you put me in a vacuum and said, okay, you have $10,000, you can make one trade, is this one you would want to make irrespective of anything I've done on this stock before? And I would say yes to that. So that's the logic I want to use going forward. It is important when we get into this habit of rolling things over and over and over, you could fall into a little bit of sunk cost fallacy, which I admittedly am completely guilty of sometimes. But at the same time, I have tried to do a little bit better of a job lately at stepping back and saying, okay, I don't want this. And that's an example of what I did right here with VGAC. And the other thing I did this week is I'm going to get out of this STON position, because that's something I've evaluated and said, hey, I don't want to be in this one anymore. And let's pull this one up here really quickly and let you know why. So our initial play on this was, we sold these 2.5 strike calls, and we can go back over to the trade tab really quickly to show what it looks like. When we started this trade off, it was trading at 2.7. So, a long way above what it's currently sitting at. It's dropped 37%, but we were able to sell 2.5 strike calls for 60 cents, which, as we know, is a direct reduction of our cost basis. So our break-even price was the 270 basis of the shares that we bought, minus the 60 cents of premium we collected for 210. And, the grand idea was that this thing was going to either stay flat, go up, or just not drop 20 cents on us. So these would have gotten called away for 250, and we get a 20% return really quickly. Easy money. As we know in the market, there isn't a ton of money that is that easy, especially when you're gunning for a 20% return. But we gave it a shot. I think it was worth the shot based on some similar plays that we'd set up. Not every play is going to be a winner. That's okay. Normally you'd say, okay, you've got these shares with the 210 basis, though. Why don't we just keep selling covered calls? And this is where you run into a little bit of an issue. So looking forward at the May covered calls that we could have sold, they'd be between 5 and 10 cents. And really, I'm not sure what that would fill at. And when you look at the volume as well, there were only 7 of those traded, as opposed to, I think, hundreds were being traded at the time when we opened this trade. So that's one. Look, it went down. We're sitting on a loss. There's not a ton of premium that we're going to be able to collect going forward. And additionally, there's not a ton of volume on the options that we're trying to get our hands on. So it's better to just step away from this one, take the loss, take the capital that we've invested in there, and just put it elsewhere. So that is the other trade that we're going to be planning on wrapping up this week with the loss. And that takes us down to RMO. And that is also one that has gone down a decent bit since we jumped into it. So let's take a look at RMO. Now this was a SPAC, as is the case with a lot of these things that pop up in our Discord. You'll see us trade. But this one, you know, net asset value of 10, jumped up to 40. So there's obviously some upside on here. People are super bullish about the company, about the industry, with, you know, electric vehicles and things of that nature, and the new administration we've got in the United States, and how they would find a place and carve out a bit of what should be a pretty big industry, dollars wise. So it's dropped back down to 10, which you presume that was their net asset value for a long time. Nothing too crazy probably has changed about this company in the past 3 or 4 months. I think 10 is definitely a lot more fair of a valuation than when it screamed all the way up here to 40. So I was comfortable getting in at this level, long story short. And what really brought this to my eye was the amount of premium that we were able to collect off the heels of this jump up to about $13 a share. And if we poke over to the news really quickly, that happened because they had a battery deal with a truck maker. So that sometimes some of the issues with these SPACs are that their pre-revenue are a little bit too speculative. The fact that they have an agreement to make batteries for an electric vehicle maker, to me, kind of gives substance to their business, gives some credibility to it, and a much more bullish outlook for the future. And when you combine that with the kind of premium that we're looking at over here, it becomes a very good value proposition. I mean, even the 9-strike puts that expire, in 2 days from now, these have 22 cents of extrinsic value on those. So, I mean, you could sell those. Let me pull the calculator up here really quickly to put some numbers in front of what I'm trying to say. But 22 cents of extrinsic value on something that requires 9 of collateral is a 2.4% return in just 2 calendar days. Yeah, Thursday and Friday till the end of the week. A 2.4% return in 2 days is super good. So what we had done originally was we sold 10-strike puts. We took a little bit of a loss on those, and let me pop over to my trade tab over there. So what we did well on this one was we scaled into it with the typical, you know, advice that we like to give via the HT wheel, being that, you know, don't throw all your capital at it at once. We started this thing at 1134, which if you look at the chart and we zoom into I think the 10-day will be a good way to look at this one. Yeah, so it popped up to 1364. So, you know, there might be a little bit of upside from here, especially. But after it dropped down the day after that, we thought, okay, you know, this might be a good entry point right around 11. Give you the exact number. Yeah, we started at 1134, so right here. And this was, you know, April 7th. This was exactly 7 days ago. So we bought 1,000 shares, and those obviously have not had the greatest return for us. But the good part about this is we were able to sell 12.5 strike calls that expired this Friday for 66 cents, which we rolled to 10 strike calls for May. We'll get to that in a second. But we liked the idea of having 1134 minus 66, like a 10, I don't know, 60 something basis off the bat, 1070 something. Mental math is leaving me this late at night, but the idea was we were happy with the basis in the high 10s right around here, especially when the options were expiring in less than a week. So we jumped in there. We didn't like the fact that it dropped, so what did we do? Since we didn't throw all of our capital that we were comfortable investing at it off the bat, we still had a little bit on the side, so we sold 20 of the 10-strike puts for 77 cents, which right here we thought, okay, we're perfectly happy with having a 930 basis potentially. Those dropped even further. We bought to close those for $1.20. We have this as a 0 in here because we rolled it for a 10-cent credit, so that's what we're calculating right here. But we were able to close these out for $1.20 and then sell to open the 9-strike puts for $1.30. All in all, this is a lot of different trades, a lot of moving parts on this one, but what we were able to do is on a trade that we started when it was at 1134, we were able to get our break-even price down to 882 in just one short week. So that was a combination of rolling forward the covered calls for an 81-cent credit and rolling. Not only were we able to roll the puts for a credit, but we're able to roll them down a strike, which is awesome because formerly with the 10-strike puts, we needed to finish here to hit max profit. Now we can have it finish above here and hit max profit. So anytime you can kind of lower that while still getting a credit on the trade, meaning that we can get 10 cents more of premium on every single contract that we sold, that's always a plus, and is what has helped get our break-even price so low. And we were, pretty confident about this one and loved the way that these May 21st 9-strike puts look. So we sold 20 more. So we currently have 40 of these sold, 1,000 shares that we're still holding on to, which potentially could get called away at $10 a share, which would be a loss on the shares, but we'd be pulling enough money from this side of things for that to look good. And just one question that might come to your guys' mind while looking at this is, how are you showing this kind of a profit right now? And the way we calculate this is for automation purposes, since really the only thing we could have perpetually updating in this spreadsheet is the live share price instead of the options price. We just calculate what it would look like on expiry day. So we strip out all of that extrinsic value. So if RMO finished at 890, this is what our trade would be looking like. So not too bad at all things considered, and double checking that again after how some of our tables looked earlier. That is taking all of these into account. Yeah, so we'd have a nice 11.12% return on capital just if this thing finishes at 890. So long story short, this thing could have dropped 21.5% in the month or so that we plan on playing it, and we can still come away with an 11.12% return on capital. And that is the advantage we find ourselves having when we're able to find plays that offer this kind of option premium. And that does lend itself to some riskier stocks, and that's something that I know when we're having red days in the face of the S&P 500 ripping to all-time highs is something that can get a little bit frustrating. So that is why I think in the near future, once plays like this wrap up, I'm going to be looking to get into something like AMD a little bit more frequently, because this is one where, maybe steady isn't the word because it's been ripping up and down, but it's a more solid company. It's more closely correlated to the S&P 500. If the market moves upwards, if the tech sector moves upwards, it's likely that AMD is also going to move upwards. And additionally, this is one of the larger stocks that, if we look at it from a return on risk perspective, it's going to be giving us decent weekly returns. Yeah, a little bit, you could definitely put that in quotes, Sleepy. Everything's subjective in here. But from the perspective of a larger stock, we love the fact that, there's only 2 days left in the week. So at the money put offering 1.07% return is still pretty solid. And then I guess maybe to get a better idea of what a week-to-week return would look like on something like this, at the money or even just out of the money gets you around 2% a week, which is really, really solid. One thing to keep in mind with AMD is they actually have earnings coming up on the 27th. So after this series, the April 30th series is going to have that premium baked into it. And we could see that already with the fact that these things at the money are offering 4.53%. But we like to talk about earnings plays. It hasn't been earnings season for a while, but it's finally starting to kick back up mid-April here. So we could get back into some of our 10-day plays that we like to run so much and probably should run a little bit more of, because they were largely pretty successful with the way we set it up. And for those of you who aren't familiar with that, there's pretty much 3 steps. The first step is we know that AMD, let me get you an exact date right here. They present earnings 4/27 after market. So the week before earnings, historically, and this is based off good Lord, losing my ability to speak. This is based off of peer-reviewed research that we were able to find. In the week before earnings, greater than 50% of the time, a stock will be green. So what that means for us in the context of what we want to do with this 10-day play is the week before earnings, we want to sell an at-the-money put. So for this one, it would be a 78.5 strike put, and we got Bones in the YouTube chat. We are doing good. Appreciate you popping in for the stream, Bones. And while we're doing this, I am kind of getting to the back end of what I'm sitting on and what I'm currently looking at. So if you guys have any stocks that you want me to take a look at after that, feel free to throw them in the chat, and I could throw them on my little scratch notepad that I've got going over here, and we can start hitting those after I get through my little spiel that I got for you guys tonight. But back into the 10-day play, the first step of this, since we know from research that stocks typically go up the week before earnings, which gives us a little bit of advantage and lets us know historically that there's a greater than 50% chance of this hitting max profit, is we sell an at the money put. That again would be the 78.5 strike put for April 23rd, and that's what we're going to start this playoff with. And that offers 2.34% return, and we know there's a greater than 50% chance of us getting that return, and that is a phenomenal weekly return. But let's say, hey, it doesn't go up. What happens is in the minority and it goes down. That's okay. What we're going to do then is take assignment. So 78.5 minus 1.7 is going to be 76.8 roughly. Someone maybe fact check that. But our basis heading into earnings week would be 76.8, at which point we could sell a call that is above our strike price. And we know that during earnings weeks, calls have inflated premiums. So we could even sell something like an 80 strike that we're looking at right here. And I know the numbers might be small on your screen, but right now an 80 strike call for earnings week on AMD is given about 260 of premium, which would get your basis down below 75. And if those don't hit and it goes even further, we'd close these out for something low, and then we would kind of play defense and go sell a 75 strike call for the same exact week. Long story short, the idea behind the 10-day play is that you have 3 chances to collect premium and hit max profit. The first being when you sell those cash secured puts at 78.5. The second being when you take assignment and then sell a call that is still above your cost basis. And then the third being after earnings, if they drop, closing that original call out and then selling a new call for the same week and hopefully driving that basis down even further and eventually at some point getting those shares called away. But I think, looking at the numbers here, in plain English, what this would accomplish is you're taking a stock that we like at 78.55 and putting yourself in a position where, you might make 2.34% a week, which is phenomenal. In worst case scenario, you'll probably be stuck with the basis probably close to 70 once this little 10-day maneuver is all said and done. And that's probably a place you would be very happy holding it when we look at the 180-day chart, because it has not been down there in the last 180 days, save for a little bit towards the tail end of July last year. So that is the idea behind the 10-day play, and that is why we're looking at that as kind of our first one that we're going to use to kick it off. And another great thing that I want to point out for those of you that do use margin is sometimes if we're playing some of these riskier stocks, a lot of brokers have a 50 to 100% margin requirement to sell puts, meaning that if you wanted to sell a cash secured put on AMD and it was a risky stock, your broker would require 78.5 times 100 as collateral. Sorry, I was getting my calculator up. 78.5 times 100, meaning you would need $7,850 of collateral per put that you sold, which for some people could be a pretty significant amount of money. Now, if you have margin, what TD does for margin privileges is recognizes that, hey, look, AMD is a little bit different than, a crypto stock, for example. So we don't need to require 78.50 of margin. And we could look in here if we wanted to sell one of these where we normally would expect fully cash secured, it would cost us 78.50, and you could see that here close to it reflected in the max loss. But what we see here with our buying power effect is that it only takes $1,500 of buying power. So for something that normally would take $78.50, it only takes about $1,500 of buying power. So you can be a lot more efficient with your cash. Now, what I will warn, the downside to that is that, if AMD tanks and goes to 60, you're pretty heavily leveraged in that margin. So it's definitely something where I wouldn't recommend going all in. But if you wanted to supplement a decent, like 10, 20, 30% of your account into that, and then, have still 70, 80% capital on the sidelines or in other plays that you could move into AMD if things start going down for you, that's a decent way to do that and a great way to be more efficient with your cash and get what would be better than a 2.34% return, because if you're pulling a 1 point, we'll put the number back into the calculator here. We know that if we were able to sell this for $1.80, that's $180 of max profit divided by 1,500 of collateral, means that what would be a 2.34% return on risk if it was fully cash secured is now a 12% weekly return thanks to the margin privileges that they gave you. So that's one way. If you're looking at something like AMD and thinking, these numbers are kind of low, one better way to look at that would be potentially to factor in margin requirements and calculate return based off of that. So that's something that previously I did like to play some riskier stocks just because, from an ROR perspective, they're better. But if you actually look into it, look at margin requirements and look at, what your actual return on capital is for what the collateral your broker requires is, you can still get some pretty damn impressive numbers by playing these quote unquote safer stocks. And that's one thing we've had mentioned in the Discord a lot is a lot of people are saying, okay, hey, SPY keeps going up week after week after week. Why is my account red? And that is something I've also asked myself a lot. But the quick answer to that is, when you're running these scans and playing these options that aren't a part of the S&P 500 and have high premiums, they have those premiums up there for a reason. And you are typically at risk to lose not a decent amount of money, but there is inherently some downside risk when you're playing things with that kind of premium. So one way to get around that and have your account reflect the performance of the S&P 500 a little more closely is to do something like this and use that margin privilege. And I think we could actually visualize. There's something in here. There it is, visualize. We can get indices right here. And the S&P 500. And you could take a look at every single stock that makes up the S&P 500. And this is a cool thing to look at for if you're ever having a day where my entire watch list is red, but the S&P 500 is green. Why is it green? You could see by sector, by stock, where the gains in the S&P 500 are coming from. You could see financials had a decent day with some of these banks reporting earnings. Energy had a good day, but in general, the sizes of these blocks are how they're weighted in the S&P 500. So the bigger blocks had red days, so the S&P 500 had a down day today. But that's a good way to not only figure out what is driving the move behind the S&P 500 on a day-to-day basis, but also potentially go through here and say, okay, these are some stocks that I want to play because I want my portfolio to more closely reflect the S&P 500. If you wanted to diversify, the way to do so is, right in front of your face right here. They've got industry broken out by information technology, consumer discretionary, healthcare, consumer staples, energy, materials, real estate, et cetera, et cetera, et cetera. And that might be the way you want to go about rebuilding your portfolio if you are concerned about your performance diverging from the performance of the S&P 500. So that is a little aside right there that hopefully is useful for some of you guys, because that is a question that we get a lot and something that I personally am working on as well. So you might start to see my plays reflect a little more of what's going on in here as opposed to me just chasing names on the scan, because that's gotten a little bit frustrating lately. But that is kind of the end of what I wanted to talk about, some of my trade ideas, what I'm doing with what I'm currently holding, what my plans for those are, and what I'm looking at going forward, with example A being AMD for an earnings play, and then example B being, potentially looking to move into some of these. And what you can do when you run a scan is filter based off S&P 500. So we could run the same scan that we run to pull out the best premiums in the market, but we could do it to scan only through the S&P 500. And that way we know that we're looking at solid, reputable companies that in general follow the flow of the broader market. And that might be a good way to start. If you want to quote unquote chase premium, you might look to chase premium inside the S&P 500 as a little bit safer of a way to do that. So I think that would be a pretty solid idea. And we've got some suggestions starting to roll in. We've got SPCE. We'll take a look at all these. SPCE, PENN, FSLY. They've got earnings plays coming up, and we're going to take a look at how we potentially would play those right after I take a sip of my water. All right. Always crisp. And then we've got, let's see. More4's got a question about doing a quick glance at the 10K filing for penny stock SURG and seeing if their current market cap of 31 million is justified. And I think that would be a super fun thing to do, deviating a little bit from, I know sometimes stock analysis can get a little bit repetitive in here because we use a lot of the same overarching principles, which I think is important, but from a viewing perspective, sometimes I know that can get a little stale. So I think that that little aside of going into looking at the 10K and trying to figure out what we think about their valuation will be something super interesting to do. But before we get into that, SPCE, PENN, FSLY, let's take a look at what we think. So SPCE, Virgin Galactic, this is one played last summer for what seemed like the longest time, and it is near and dear in my heart because it was probably our single most profitable ticker from 2020. And with the way some of what we've done in 2021 has gone so far, I think it might still be that way. But nevertheless, entry point perspective, we look at RSI right here. The 180-day RSI is down, flirting with the blue again, which we know means it's below 30, indicating that the stock is oversold and should pop up sometime soon. The last time it was in the blue was at the beginning of March right here, and that was when it ran back up from 27 to 36, but not ignoring the fact that it was also in the blue here February 25th, back when it was at 36 before it dropped down to 25. But you know, there are some exceptions, but we do like to look at RSI when we look at all of our stocks because it is historically a pretty solid indicator of when things will spike back up or when things will fall back down after a run. But if we look at RSI right now, what it's telling us is that definitely oversold a little bit. Shout out to Sean M12345 for the follow. I always love hearing that little notification pop up. And we've got a question from you. What application are we using to get these graphs? And this is Thinkorswim. This is TD Ameritrade's trading software. It's totally free. And if anyone, I don't know if you could use it if you're overseas, but if you are in the US, I think all you have to do is just create a TD Ameritrade account. I don't think you even need to deposit any money, and you're able to do this and get into this software. I know a lot of people who actually use this software, Thinkorswim, to chart things and do research, and then go into their own individual broker to place the actual trade. But I do think this is one of the best trading softwares out there, and I think a lot of people in here would agree with me on that one because I know a lot of us use it. Another point from the chat on SPCE is that NASA and Virgin Galactic are having a launch on the 20th. If you've got any more info on that, do let me know because that's something interesting. I know sometimes they have launches that are independent of each other, but if they are having a joint launch, that would be something that's kind of interesting. I know Virgin Galactic typically has a lot of these quote unquote, and I feel like I've said that a lot. It's not until you start streaming that you realize they're certain words and phrases that you repeat over and over again, and then when I hear myself say them out loud when I'm forced to pretty much go on a monologue for 2 hours is when I start to notice it. So hopefully I could spice up the vocabulary a little bit for you guys. But typically what will happen is that they'll have these test flights, and I think recently they've rescheduled or postponed so many of them, and that's really what was going on towards the beginning of 2021 when there was all this hype about potential launches, about them getting up into the air. And then they kept pushing things back, whether it was for weather or whether they had technical failures or things of that nature. But all things considered, we know where the hype can get this stock. They've got launches coming up. I think pre-launch plays for stocks like this are great, especially 6 days out. You mentioned it's on the 20th. I think, does that fall on a weekday? Yeah. Next Tuesday. So what wouldn't be a terrible idea here, in my opinion, is because, I'd love to have a way to chart when their launches were and what the result was and what the run-up to that was. But based off what I seem to remember after following the stock over the past year or so is that, prior to launches, there are decent run-ups. So how would we want to play that? We would want to play that by selling weekly at the money puts. And for April 23rd, they give 4.43%. But as we know, thanks to I'm sticking to it because it was mentioned in the chat, that is going to be after the launch. So what we really would want to look at is something for this week, and then potentially not buying a call because we never want to do that, but maybe selling something. I think the nearest expiry would be good because you'd be in and out by the launch and potentially be the benefactor of a run-up. So I think 416 would be the best way to play that. But earnings coming up potentially, whereas SPC, earnings on May the 4th. So for tickers like SPC, and we got the comment that NASA, SpaceX are launching the second commercial crew rotation mission to the International Space Station. Oh, I've got you. I've got you. So one important distinction to make, and I'm sure you probably know this, but SPCE is not SpaceX, but they are a sympathy play for when there is a lot of excitement surrounding rocket launches from other organizations like NASA, like SpaceX. So not a terrible way to play it. And for the longest time when I played this, what I was so worried about was that one day SpaceX would go public, and so all the people who were in Virgin Galactic just to be in a space-related stock would pull their money out and sprint to SpaceX. Now, I don't think that's something that's going to happen because I think SpaceX has all the funding they need and don't necessarily need access to the public markets to get the cash that they need. So that's not something that I think is too big of a risk in the near future. But knowing that it's not a Virgin Galactic launch, let me take a look at the news feed right here, see if we can see what's going on. We've got former Virgin Galactic CFO joining the satellite observation startup. And that is right. Kathy Wood did start her space-related ETF. And as we can see here, Virgin Galactic is included in that one. So it's always good when there's institutional buying in something like this, especially when we look at it in the scope of what's going on in the last 180 days. It looks like there's probably a little bit of a base around 26 right here because that's where it bottomed out roughly the first time. And maybe below that at 22, 23, I think would be another level of support after that. But we are thinking sympathy play and earnings run up. I like that idea. And the one thing I will caveat that with as far as earnings for a company like this is a lot of what Virgin Galactic is doing right now is conceptual because, they have a bunch of pre-bookings, but they don't actually have something up working in the sky, taking customers and generating revenue on a day-to-day basis. So from an earnings perspective, all you're really going to see, unless they have some sort of news that they announce, is just really the rate of cash burn that they're going through as they run through all this research and development and try to get their business off the ground, no pun intended. So it's not going to be one of those things where, they've shattered earnings this month. The stock's going to completely shoot up. As we can see back here, there really wasn't a ton of movement on earnings. And one of the tools that we like to use in here as well is if we go to Analyze, we go to Earnings, and we type in SPCE, we can take a look at their movement from earnings over the past 8 quarters or so. And what we can see right here, not a ton of movement Q4 19, a little bit of an uptick Q1 2020, a little bit of a downtick Q2 2020, and nothing too far outside of the general trend in the first place in Q3 and Q4 of 2020. So long story short is that, what is actually being reported isn't that big of a deal. This is a much more news and results-based company. And by results, I mean what's happening on launches and what's happening with their testing and when they plan to actually start taking customers up into orbit and things like that. But at the same time, earnings is typically when they will make announcements regarding that. So I think there definitely could be some run up to earnings, and I like the idea behind that kind of a play. We know earnings are May 5th, I believe, is what we said when we looked at this. May 4th, excuse me. So we've got April 16th, April 23rd, and April 30th. We've got 3 sets of options we could sell before we even get there. So if we're banking on something like that, I think it's a great idea on a week-to-week basis, just selling, almost having an extended part of what we referred to earlier as the 10-day play, where you start at the money, and if it drops, just roll your puts for a credit and I think you would roll into earnings with the basis around 25 worst case scenario, and best case scenario you get these called away on a week-to-week basis for 2% or 2%, 3%, 4% in a week, and that's a phenomenal weekly return. So I think that's a pretty solid way to play it running up to earnings. Now, whether or not you actually want to take on the risk with earnings, and as we could see, the return on risk for earnings week jumped up to 9.89%, and part of that is because we're still, a month out from that, but the other half of that is definitely because there's some implied volatility baked into that option premium. But with that said, I think week-to-week selling of puts, really not a bad idea on this one. We know entry point-wise, a lot of room up, maybe not a ton of room down. I think 26 and then 23 would be the two levels of support if it does continue to fall. And those are two levels of support that I think you could pretty easily have your break-even price at if you did start off selling puts on a week-to-week basis at this point. So all in all, I like the suggestion. I like the play. Definitely something good to keep an eye on if you've got some cash on the sideline that you're waiting to stick into something. This really isn't a bad option. So I'll give the seal of approval to Virgin Galactic on that one at this point. So the next one we're going to look at is PENN, which is the gambling stock that is so famously been associated with Barstool, and maybe even more famously, if we go back to the 1 year chart, it says 1284 here. If we go further back than a year, we'll see this thing was $3.75 at kind of the worst part of the pandemic when it bottomed out, and since went up to 142. This is honestly, for as big of a stock as it is one of the crazier runs that I've seen on something like it. So let's go back a little nearer term to the 20-day, and it has fallen pretty far off the high of 140. Going back to the 180-day again, taking a look at RSI. RSI would suggest it's, somewhat on the oversold side, since 50 is kind of that halfway point for evaluating where something is overbought or oversold. So slightly oversold, but nothing where I would, place a trade with conviction based off the RSI here. Another thing we like to consider that I want to throw on this chart really quickly is the implied volatility, because, as we saw with plays we made on VGAC and STON, it's great when you're able to enter a trade and there's all this option premium. But if that option premium disappears and the stock is dropped, you're kind of shit out of luck. And that is the situation that we found ourselves in as we had to take losses on those two trades. So let's go to all studies. It's going to be under I. And we've got implied volatility, and it's going to plot this nice blue line for us. And as we can see on the run up, over the past 180 days, IV is about as low as it's been. So maybe from an option selling perspective, not the best entry in the world. But we do know this was an earnings play too. Yeah, so let me throw that in the watch list, click on it. Yeah, earnings, May 6, 2021. We've got another message saying esports gaming conference on the 22nd. So that's interesting. I know for a fact they've got a pretty big stronghold and pretty big brand in the sports gambling market. But if they do dip into, I'm not sure how far into the esports game they are, but if they are, that potential catalyst that you do mention there with the esports gaming conference on the 22nd could be something solid to keep in mind. But for me, on a week-to-week basis, we always like to talk about the fact that, it's so easy to fall in love with the upside and the premium on a week-to-week basis, because objectively, look, if we sell just at or out of the money, you can get 1% over the next 2 days, which is good for a stock of this size. Looking out to next week, you could go decently 4% out of the money roughly and still get 2% a week. That's really good. But where this strategy really starts to fall apart is if the stock starts to fall quicker than you could drop your break-even price. And that's when we really run into some issues. Famously is what happened to us with Hyliion, which is below $10 a share now. So good Lord on that one. And I'm glad we got out it. I'm not happy we got in it in the 50s, but I am happy now that we got out at 17, because it being below 10 is insane to me. But, back to our point here is, like, 180 days ago, this thing was trading at 31.86. Can we justify their current valuation being, 3x what it was 180 days ago? And for me, it's testing an area of lower support here in this 94 to 100 range. We see a bottom right here. We see a bottom here, potentially here, and a couple more here in this mid 90 range. Additionally, a peak in the high 90 range. If it gets below that, we could see it run back down near 80 or 70. So the one thing I would say with this one is just kind of look out below if this thing starts to fall. Now, obviously, objectively, these are awesome returns from a return on risk perspective, but important to balance that with the potential risk of the bottom just completely falling out on this one. And we could take a look at something like DraftKings over the 180-day period as well. And they look pretty similar if we switch, back and forth. There was a little bit of a dip here that was much more exaggerated in DraftKings right here. But if you want a little bit better of a valuation, 180 days ago, DraftKings was at 30, a similar price, and now it's at 59, so 2x. But we look at Penn, it was at 31, and now it's at 100, that's 3x. I'd be much more comfortable getting in on this when it's down in this potentially 90 to 80 range. So for me personally, I would stay away from this one just based off, the risk tolerance I have and experience in seeing things like this fall off the table when you buy into the hype up here. But I will tell you guys all the time that I am not some guru stock picker. I get shit wrong all the time, like way more than I should, maybe more incorrect ones than correct ones. But the one thing that I do want to impart on you guys is if you do choose to play something like this, the correct way to play it, and that would be through the options, because there's such solid weekly premiums here that you could collect. And those numbers on a week-to-week basis not only would protect you a little bit from a pullback in the stock, but would compound very nicely if it leveled off in this area or continued its climb back up to the all-time high of 142. So that is where I'll leave you guys on that one. I personally would not get in on this just because of that downside, but if you do want to get in, the premium definitely is there, and I think that's a great way to play it. I'm no stock picker. That is for sure based off some of the ones that I've picked out lately, but have still managed to be profitable on a lot of them thanks to the strategies that we run. It's almost like cheating when you're trading with a little bit of a cushion thanks to the premium that we're able to collect. So the third one that was brought up here is going to be FSLY, Fastly. And this is one that is, down to 72. I haven't looked at this one for a while because it has been all over the place. I think looking at it over the past year would probably be pretty entertaining. Yeah, it ran from 20 up to 136 before. I remember this earnings report. They completely just wrecked their future guidance, and they gapped down so far. And I remember it was one of those things where you hop onto Reddit and you see people who bought puts for earnings making these ridiculous gains, and it makes you jealous that we sell options and we just collect, smaller gains over a period of time. Candles like this and seeing the gains that people make definitely can make you a little bit jealous. But in the long run, we'll perform better than they will. So that's important to keep in the back of your mind. Stay patient. But I'm getting a little bit off track here. We've got a comment saying Fastly and Okta joined forces, to offer in-depth identity protection against security and fraud risk without impacting user experience. So that's an interesting headline. I don't know, how much that would fundamentally impact the value of the stock. And maybe a better question at this point would be, what is the fundamental value of the stock, since it's ranged from 136 down to 65 and then back up to 120, back down to 58, and then, relatively settling right around where it is at 72.35. But let's take a look at the option premium. Let's go through the process. And they do have weekly options. That's always something good that we like to see. Let's take a look at F. Let me put it in here. And they present their earnings May 5th. Okay, so that's another one where you're going to have, 1, 2, 3. Put this down. 1, 2, 3. Yeah, you're going to have 3 weeks of earnings, 3 weeks of options you could sell on this one before you run into earnings. And on a week-to-week basis, these again offer some really solid premiums. Now, with what we had in mind here when I mentioned the fact that, this fell off a complete cliff because they ruined future guidance with earnings. They ruined guidance before earnings, and then they reported earnings and, outperformed that shitty guidance. And I think something similar might have happened here where they said, okay, we're not going to perform as well. They announced earnings and then actually didn't perform that well. When you see things like that happen and management lowers expectations, it's not uncommon to see a stock, beat those lowered expectations. A lot of times companies do that just so they can beat the following quarter, and beating is kind of subjective because analysts set target based off information that management gives them. So, it's pretty easy to mess around with these price targets the way that they did back here in 2020 in October when they said, hey, we're not going to beat earnings, lower our expectations. So not only were the expectations lowered, the stock price was severely lowered as well. But they then in turn beat those lowered expectations and ran back up. So this really isn't too bad of an entry point. And if we want to look at RSI again, I don't know why it disappeared on me. Let me pull it back up. Okay, interesting here is that it's on the 180 day. It's indicating that it's a little bit overbought, which, makes sense looking back at the end of March since this thing was around 64. So that maybe would give me a little bit of hesitation from an entry point perspective. I think you might definitely see something, at least based off the RSI reading that we're getting right here. You might see something under 70 in the near future. So maybe holding off a bit on that one and waiting for a slightly better entry point might be a good way to handle that. But again, take a look at the options. We say, okay, maybe something inside of 70 might be a good entry point. Well, the way we could do that with options is essentially selling puts is equivalent to a limit order. We could sell a 70 strike put, and if we're wrong about it pulling back and it runs away from us, guess what? We'll still pull 1.13% in the next 2 days. But if we're right about the pullback, we'll be assigned shares, or we could roll puts. But if we were assigned the shares, it'd be with the basis of around 69, 20, or 30. Nice basis based off what we saw right here. So that wouldn't be too bad of an entry point. A little bit lower than what we're currently seeing when it closed at about $72 at the end of the day today. But again, important to keep in mind these 416 when we're doing this on a Wednesday night, these probably aren't the best indicator of what kind of premiums you're going to see on a week-to-week basis. You'll probably see something like this, which is offering almost 4% a week. And that really is not too bad at all. Depending on how safe you really wanted to get here, let's take a look at all strikes. I mean, you could still pull 2% by going for the 68 strike for next Friday, April 23rd. And that would be an adjusted basis of roughly 66.50. So you could set up a play that would, pay you 2% with a pretty big cushion. And if that cushion gets broken through, you're sitting with the basis 66.50 right around here. So that's a pretty solid discount looking at this in the context of what's been going on the last 180 days. And on top of that, we love the fact that earnings are coming up as we mentioned. So let me minimize this a little bit. And what you're going to see is if you are assigned those and you've got a 65 strike basis, you could sell something kind of at or above your cost basis for $4 or $5, which would get you back down to a basis of roughly $60. And that would put you right around here, just under an area of long-term support. We got a couple people popping in the YouTube chat. Jeremy Narvaez. I probably pronounced that so incorrectly. Jeremy Narvaez. That is going to be my final. What's good? Appreciate you popping into the chat. We got another question from YouTube about could we go over RMO. We talked about that a little bit earlier, but I'll touch on it really quickly right after this. Wrapping up, closing the loop on what we were saying with FSLY is, it's trading at 72.35 right now in the context of what's going on in the last 180 days. Pretty good entry point, but RSI indicates we might see a little bit of a pullback. If you are worried about the pullback, start off by selling puts a little bit further out of the money. And then if those are assigned, you'd be happy to take assignment in mid-60s. And then if you are assigned on those, great news is that earnings are right around the corner. We know expectations might be a little bit lower. They might be poised to beat those earnings. Regardless, there's still some really, really nice call premiums that can get you even further down and conceivably have you with the basis below $60 as we head into May. And on the chart, that is below pretty much every area that it's bottomed out at in the last 180 days. So I think that's FSLY, definitely a pretty good entry at this point. Now, one thing I'm curious about, we had the discussion about margin earlier, is, to sell one of these, normally this would take 7,000 of collateral. But with broker margin, let's see how much buying power that would take up from us. Come on. And that would take 2,600 of buying power. So yeah, honestly, not too bad. We got another question on YouTube about what this play is. And this is, someone had a suggestion about ticker FSLY. And what we do with all of our plays is we look at them from the scope of option selling as opposed to option buying or stock buying. And the way to handle this one, we think, would be, you could even start off with one that expires in 2 days where you're collecting 1-2% in just a couple of nights, which is a really, really solid return. Or you could play it a little safer, start out with the April 23rds and, start with something in the 60s and still pull roughly 2.5% over the course of next week, which also isn't bad at all. Looping back around really quickly before we wrap up our stream with going over a 10K and determining the valuation of one of the companies mentioned in the chat from earlier. We're going to look at RMO and show what we're doing with that one again. So as you can see, I don't know if you can tell on the screen, but the monitor that I'm on right now is super, super laggy. So that mouse might be jumping around a little bit. But with RMO, this thing was at 10 for the longest time because it was a SPAC. That's that $10 price floor, ran up to around 40, has since pulled all the way back below that down to 7.7. But at this point, they announced some news that they were forming a deal with an electric truck maker that they would be the battery supplier for, which, lends some credibility to their business. A lot of these are speculative businesses in the EV field. So getting that kind of customer agreement is always big news. It spiked up to 13 and is then pulled back down to about $9 a share. But that kind of volatility has created some really, really good premium in the options. So what's happening right here is we could sell 9 strike puts for May. That'll give us a 16.5% return on capital risked, which is a really, really solid return for 1 month. And additionally, with $1.25 of premium on these, your break-even price on that is going to be $7.75, which on the chart is right. Good Lord, this thing is lagging so badly. Bear with me. It's right about, I may never hit it. Yeah, it's right about here at that gray line. So essentially what you could do with those 9 strike puts for RMO that expire May 21st is set up a play where as long as it finishes above this little line where I have my mouse at 775, you're going to make money. And as long as it finishes above this other line that I'm going to put on here at $9, it's at $8.93. Bear with me, I'm not going to get it exactly, but as long as you can get it above $9, you're going to hit max profit, which, as we see when we flip back over to this tab, is 16.5%, meaning you'll make $130 per contract that you sell if this thing finishes above $9 on May 21st. And that is a really solid value proposition, and is the reason that we have sold 40 of these. So we're hoping to pull pretty decent haul from that play. So that is what we did with RMO. If you've got any further questions about that, feel free to let me know in the chat. I know we've got a lot of people who come into our, streams, into our channel, into our server where this is new to them. So when I'm talking about something I do a lot, I might not describe it necessarily in a way that makes sense to those of you who are new. So if there's anything I could ever clear up, always feel free to ask. There's never such thing as a stupid question, both in here and in our Discord server. But with that said, we're going to jump into the grand finale of the night, which is going to be ticker, let me scroll back up to the message, SURG, I believe it was. I'm scrolling through my chat, bear with me. There we go. The latest 10K for the penny stock, SURG. Now we know penny stocks are a no-no, but because More4 is such a valued member of our community, we're going to take a look at it. So taking a look, the first thing we like to do if we have no idea what we're looking at is take a look at the Analyze tab here, which is always super helpful. So because I have no idea what I'm looking at right here, we're going to take a look at that Analyze tab, click on Fundamentals, type in the ticker again, SURG, and it should give you an overview of what it is. So SurgePays, formerly Surge Holdings Inc., is focused on telecommunications, media, and financial technology applications, serving customers online and across social media, gaming, and mobile platforms. Its business models include True Wireless Inc., blah, 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 blah. So basically, communication company. And More4, feel free to throw any other supplemental info you've got in the chat to kind of help me out as I go through this. But let's jump into it and how we're going to evaluate whether the current price is reflective of the true value of the company. So how do we know the value of a stock from a valuation perspective? The easiest way to do that is going to be with market cap. And essentially market cap, we're flipping back over to this chart really quickly, is just the price of the shares times the number of outstanding shares, and that should give you a general idea of the value of a company. So if we go here, we're going to go SURG stock. The easiest way to find some of this stuff sometimes is just to Google it. So the market cap, as we can see as of market close today, is $30.64 million. So let me pull up a notepad. If I can get a notepad up and going. I'll just use the one. Hold on. Bear with me. Bear with me. All right. So here is our analysis, and this is how it's going to look. SURG, we know the actual value is kind of the market cap. So this is, we're going to call this, current, or we'll just call it the current value. And that is, as we see right under this window right here, $30.64 million. So what we want to do is take a look at the financials and say, from a fundamental basis, does what this company presents in their financials match up with a $30.64 million market cap? So question number one might be, how do we find a company's financials? And the way to do that is Googling SECEDGAR, which is going to be the SEC's Edgar database. And when a company announces earnings or something like that, or you see news about a company filing, this is what people are talking about. All companies that are registered with the SEC, which is a requirement to be traded on the US markets, have like a profile or a page on this website. So let's take a look at the latest 10K. And they've actually, since I've been on here last, reorganized this to be a lot more readable. Typically, let me click this view filings. Oh my gosh, this lag's getting bad. All right. Please don't crash on me. Not on the stream. All right, yeah, so typically it looks something like this, where you would have to just page through lines and lines of what sometimes can look like nonsense in the world of SEC filings, but now that they've got a breakout of 10K, which is the annual report, which is what we're going to want to look at here, this could be a lot more helpful. So let's click on that, and it is going to take us to SurgePay's latest annual financial report. So what you're going to have typically in the 10K is you're going to have financial statements. You're going to have a bunch of, administrative type stuff at the top with, audit opinions, accounting issues, critical accounting matters. And then you're going to have management discussion and analysis, which provides a little bit more context into the numbers that they present, and is honestly a really good way to learn about a company itself. If you have no idea what's going on with the company, just taking a read through the MD&A or reading the company overview or description of the business right here, for example, is a really good way to learn about the company. So what it says in the 10K here is that it's a technology-driven company building next-generation supply chain software. Let's see. It's a multi-purpose e-commerce platform, and it looks like they have a few different lines or things that they offer. And let me zoom. I'm certain this is so small on you guys' computers, so let me zoom in. Hopefully that's a little bit better. Feel free to let me know if that's still too small. But since this might be a little bit harder to navigate through, let me go back up to the table of contents and click down to the financial statements. Let's see. Selected financial data not applicable, huh? That is interesting. Let me just control F and see if they even have like a balance sheet in here. There we go. It's in the appendix. So here is their balance sheet, and pretty much the two most important financial statements are going to be the balance sheet and the income statement. Cash flow is, sometimes important, but the cash position of a company can be pretty easily manipulated by executives. So it's not something I put a lot of stock into when I run analysis on the financials of a company. So first thing that's important to look at with a penny stock is you might imagine that they're a penny stock because they might be in some dire financial position. So as of right now, they have 7.3 million. It looks like, these aren't typically you'll see sometimes that financial statements are presented in thousands. So this would be 7.3 billion, but that's not the case here. It would indicate it right around here. So they have $7.3 million in assets. However, only 1.2 million of that is current assets, which, is considered your liquid assets, something that could be relatively easily converted into cash. So under that, you have things like literal cash. You have accounts receivable, which is payments from customers you haven't gotten yet. You have inventory. But, it does kind of concern me a little bit that of the 7.3 million in total assets that they present, only 1.2 is current. And the biggest item that they have on here is intangible assets of 4.1 million. And those have faced accumulated amortization of 1.6 million and 500,000 respectively. So those have been cut into pretty significantly, and I would be interested to see what they refer to as intangible assets. So those are going to be things like trademarks and patents. So if they have some sort of proprietary technology, that is probably what flows into this line item. And this is where you could get pretty subjective about the valuation of things like that. So this is a little bit sketchy. Looks like we've got someone saying the stream is buffering. If you guys can see me, hear me, if your stream's looking good, please let me know. But hopefully we're still on. Let me throw something in the chat real quick just to make sure. Brief intermission here as I make sure that the connection and the stream are still going strong, hopefully. Crickets so far. Not all the time, unfortunately. Okay. This is kind of the end. So hopefully those of you that are still tuning in can still see the stream through the pushing through the analysis here. Hopefully, since this is kind of the end of it, we can, finish this one up and wrap it up with this last little bit of analysis. But going back down the balance sheet, 7.3 billion in assets, only 1.2 are current assets, and a huge chunk of that is intangible assets, which are kind of sketchy in the sense of, what you're reporting as assets, especially when they're that big of a chunk. Now, what's more interesting to me is when you look at the financial position of a company. What? Okay, this is interesting. So they have 7.3 million in assets. We know that they've got 4.1 million in intangible assets. Whatever, we'll give them that for the purposes of this example. 7.3 million in assets. They have 18 million in liabilities, of which 15 million are current liabilities. So they have accounts payable, related party. These might not, depending on who the related party is, these might not be that significant. So we can ignore about 1.7 of those. However, they do have 5.6 million of accounts payable to non-related parties. They have related party debt, which is, probably something we could overlook. But they also have notes payable and current portion of long-term debt that is not related party of 2.2 million. I mean, these two items alone, the top and then the bottom, the 5.5 and then the 2.2, those alone are current liabilities in excess of all of the assets that they have. I mean, this is a company that's screaming bankruptcy. And the other thing that sticks out to me is we know that on a balance sheet, assets equals liabilities and stockholders' equity. So those are the three big sections that we have: assets, liabilities, and stockholders' equity. Assets equals the sum of liabilities and stockholders' equity. What's interesting here when we look is that assets are 7.3 million, and we already see that liabilities are over that. So the issue with that is, as you can see here, stockholders' equity is negative, which is something I don't think I have ever seen before in any of what I have taken a look through. Okay, appreciate that feedback. Stream was buffering, but not too much anymore. Hopefully, yeah, it looks like my connection is kind of teetering a little bit here towards the end of the night. I might look into potentially resetting it before the next stream so that doesn't happen again. We were going pretty strong before, but hopefully we could keep this up without dropping a ton of frames. Come on, stay strong. Here's what we're going to do. We're going to close out of Thinkorswim because I think the encoding is getting overloaded again. All right, I think we should be streaming smoothly now. And hopefully Thinkorswim will close in a second, free up a little bit more computing power for this little... That's the thing about this new little laptop I got. It does not quite have the processing power of the one that broke, unfortunately. So what we've got is what we've got right now. So we might have that issue a few more times, but I think based off what I'm seeing on my side, we should be back, not buffering, streaming smoothly right now. So getting back to the point is that, you know, they have these assets. Not only are their current liabilities twice as much of all assets they have negative stockholders' equity, which is referred to herein as stockholders' deficit. In my line of work, what I do, I evaluate a lot of companies for private equity firms and corporate clients and buyers. This is something I have never actually seen in practice. And this is maybe the biggest red flag I've ever seen with the company is having negative stockholders' equity. But, you know, fact of the matter here is this is a company that's staring bankruptcy in the face. It's not one of those things where, you know, they've got a pretty high stock price. They can issue shares to collect a little bit more cash. One, they would have to, you know, 15x the current assets on hand just to meet their current liabilities. So they're on a one-way path to bankruptcy based off what I'm looking at right now. And even 30 million of value from that market cap is too much. I don't know if there's anything in the news about them potentially restructuring debt and getting a lifeline or something like that, but even just based off the balance sheet, it doesn't look too good. And we could take a look down at the income statement and keep going here, but they lost $8 million in 2019 and lost $10 million in 2020. Interest expenses getting higher and higher because they're taking out more and more debt, and it doesn't look like they can afford this kind of interest expense, to be honest with you, based off what we just saw on the balance sheet. Let's see. I mean, their revenue has doubled year over year, so that's good. They pull 54 million in revenue, but you know, the cost of revenue, their margins are horrible. They're only pulling 2.4 million in profit off 54 million in sales, which once netted against everything that they have to incur on an other income and expense basis, I mean, they're not close to sniffing a profit. So this is something I would definitely stay away from. I don't think this company has any intrinsic value at all based off the debt they have. I would imagine that sometime in the future, over the next year or so, this company is going to declare bankruptcy, be forced to liquidate their assets because, you know, maybe in the past a lot of their debt hadn't come due. However, even just the current portion of this long-term debt that they have right now is pretty substantial, and I don't think they have enough on hand to cover it right now unless these intangible assets are something that they would be able to sell off. But that would be something where, you know, if they have 4 million of intangible assets,